Your health insurer is not allowed to look at your medical history when it prices your plan. Not chooses not to. Not allowed. Under federal rules, a company selling individual coverage cannot ask what you were diagnosed with last year, what you take every morning, or how many nights you spent in a hospital. It can price you on 4 things and only 4 things. How old you are, where you live, how many people are on the policy, and whether you use tobacco. Health status is off the table. So is gender. So is gender. That has been the law for over a decade. Which leaves a question almost nobody says out loud. If the price is not about you, then what is it about? I want to answer that today, because the answer explains a number that landed on a lot of kitchen tables this year and a bigger one arriving in November. 3 things. How the price of a health plan is actually built, where that 58% increase came from, and why insurers are asking for another double-digit jump next year when a piece of that increase has nothing to do with medicine getting more expensive. That last part is not a theory. It is written down in public documents by the insurance companies themselves. We are going to read it. Start with the arithmetic, because it is simpler than the industry makes it sound. A company selling individual plans does not price you. It prices a pool. It takes everyone expected to buy that plan next year, adds up what it thinks their care will cost, and divides. That is genuinely most of it. Expected cost of the group divided by the size of the group. Most of us have quietly assumed that the number on the renewal letter is somehow about us. It is not. And that is not a mistake anybody made. It is just a thing that never gets explained. Then there is a ceiling on the rest. Under the medical loss ratio rule, an insurer in the individual or small group market has to spend at least 80 cents of every premium dollar on actual medical care and quality improvement. For large group plans, it is 85 cents. Miss the target, and they have to send money back to customers. So the slice that covers salaries, marketing, claims processing, and profit is capped at 20 cents on the dollar. That is a real protection, and it does real work. But look at it one more second. The cap is a percentage. It is not an amount. 20% of a small number is a small number. 20% of a bigger number is a bigger number, which means the one lever that reliably grows the dollars a company gets to keep is the total getting bigger. I want to be careful here, because this is where finance videos usually drive off a cliff. I am not telling you that anyone is inflating costs on purpose. I could not prove that, and neither can anybody else. What I am telling you is what the rule does when you write it as a ratio instead of a number. Health economists have a name for the shape that creates. They call it cost plus. That is the machine. Now watch what happened to it. At the end of 2025, the enhanced premium tax credits expired. Those were the expanded subsidies that had been knocking down what people actually paid for a marketplace plan. When they lapsed, the sticker price of the insurance did not change overnight. What changed was how much of it landed on the household. Here is the number. The average monthly premium people paid after subsidies went from $113 to $178, 58% in a single year. And the deductible moved with it, up by about $1,027, 37%, to a record average of $3,786. So, more every month, and more to spend before the coverage does anything at all. People responded the way people respond to prices. Some of them left. I want to be very clear about this part because it usually gets told badly. Nobody in this story did anything wrong. A price moved, and households did the arithmetic they were being asked to do. That is not a failure of discipline or attention. Reacting to a price is what a price is for. But here is what it means for everyone who stayed. Look at who left. Households earning between 400 and 500% of the federal poverty level, the group sitting just above the subsidy cliff, were about 3% of the people signed up in 2025. They accounted for 27% of the drop. Adults between 18 and 34 made up 46% of the decline, 542,000 people, an 8% fall in that age group. higher income, and younger, not sicker people. On average, cheaper people. The headline enrollment number went from 24.1 million plan selections down to 23.1 million. But picking a plan and paying for one are different things. Measured by who is actually paying premiums, the drop is far bigger. From 22.3 million in 2025 down to a projected 17.5 million by one estimate and about 18.9 million by the government's own. Those projections disagree with each other. Every one of them points the same direction. Now go back to the arithmetic. Expected cost of the group divided by the size of the group. If the people leaving are on average the ones who are costing the least, then the average cost of everybody still standing there goes up. Nobody got sicker. The composition changed. So how does an insurance company put that into next year's price? It writes it down on a form and sends it to the government. Every year, an insurer that wants to change its prices has to file for it. The filing goes to a state regulator. It has to include the reasoning, and in most states, the public can read it. For 2027, researchers went through the filings of 77 insurers across 16 states and Washington, D.C. The median requested increase is 14%. The range runs from 1% all the way to 52%. 20 of those companies asked for more than 20%. The number of companies asking to lower their prices was 0. Some of that is simply medicine costing more. The median underlying medical trend in these filings, the cost of care and drugs before anything else is added, is about 10%, which is high by historical standards. The new weight loss and diabetes drugs show up over and over. One insurer, Exelis, put the rise in those drug costs at $28.30 per member per month between 2025 and 2027. Some companies dropped weight loss coverage for them and said that pulls their 2027 increase down. Others said usage keeps climbing regardless. But then there was the other line. Insurers also have to account for the change in who is in the pool. The industry word for it is morbidity. They estimate the shift pushed 2026 premiums up by roughly 4 percentage points, and they expect roughly another 4 points in 2027. Individual companies filed adjustments between 4% and 7.7%. Read that plainly. A slice of next year's increase is not the price of care. It is the price of the departures. Stack it all up, and premiums for these insurers would rise by more than a third between 2025 and 2027. None of this is new. We have watched a version of it before, and we have the receipts, because a state ran the experiment for us. In 1993, Washington State passed the Health Services Act. Insurers had to accept everybody regardless of medical history, and prices were community rated, much like today. The design also included a requirement that individuals carry coverage. That was the piece meant to keep healthy people in the pool. In 1995, the legislature repealed that requirement. The rest of the law stayed exactly where it was. So the obligation to cover everyone remained, and the reason for a healthy person to buy in early disappeared. You could wait until you needed it. What followed is one of the cleanest sequences in American insurance history. Between 1993 and 1998, 17 of the 19 companies selling individual policies in Washington left. Premera raised the price of its most popular plan by 78% over 3 years. The last two carriers, Regions Blue Shield and Group Health, stopped writing new policies in 1999. There was no individual market left to buy from. Not a bad one. In 2000, the state changed the rules again. A 9-month waiting period for pre-existing conditions and a high-risk pool for the sickest applicants. Companies came back. 9 of them, not 19. And the share of Washington residents with no coverage at all was 13%, the same as before the entire experiment started. Now the honest part, because the differences matter as much as the similarity. Washington removed a stick. What expired at the end of 2025 was a carrot. The federal marketplace still has its base subsidies. It has risk adjustment machinery that Washington never had, and it is enormously larger. I am not going to tell you what happens next, because nobody knows that. But the direction this mechanism pushes is not in dispute, and it was not in dispute in 1995 either. That is exactly why the sequence is worth carrying around in your head. Now, most people watching this do not buy insurance on a marketplace. Around 154 million Americans under 65 get it through work. So it is fair to ask whether any of this reaches them. Start with what employer coverage actually costs, because that number is almost never said out loud. In 2025, the average family plan cost $26,993 a year. The worker paid $6,850 of that. The employer paid $20,143. And I want to give you the fair version of the trend, not the frightening one. Over the 5 years to 2025, family premiums rose 26%. Wages over the same stretch rose 28.6% and inflation 23.5%. On that measure, premiums were not outrunning everything else. That is worth saying because it is true. 2026 is where it turns. Mercer surveyed more than 1,700 employers. Health benefit cost per employee is expected to rise 6.5%, the largest increase since 2010, from about $17,500 per employee to more than $18,500. But 6.5 is the number after employers act. If they change nothing at all about their plans, the same survey puts it close to 9%. Those missing 2.5 points did not evaporate. They turned into higher deductibles, higher copays, and narrower networks. The bill did not shrink. It changed shape. And that $20,000 your employer pays? Where does it come from? Most health economists will tell you it comes out of what would otherwise have been wages. I will also tell you the evidence is not unanimous. Some studies looking at specific workforces have struggled to find that trade-off cleanly, but it is the standard assumption in the field, and it is the reason the biggest line in your compensation may be one that never appears on your pay stub. I want to end with the one place in this story where somebody actually pushed back. On July 22nd of this year, regulators in Massachusetts finished reviewing 2027 rates for the state's merged market, covering roughly 700,000 people. The carriers asked for an average increase of 12.9%. The state approved 10.4%. That gap is about $72 million that will not be collected. Blue Cross Blue Shield asked for 15.3 and got 13.2. Tufts asked for 11.8 and got 7.5. Harvard Pilgrim asked for 6.7 and got 6.7 because when a number is defensible, there is nothing to argue about. And one filing was turned down outright. Fallon Community Health Plan asked for 25.7%, covering about 29,600 people. Regulators called it excessive and said no. Even after all of that, the approved increase is still nearly 3 times the state's own healthcare cost growth benchmark of 3.6%. This is not a happy ending, but it is a useful one, because it is the only moment in this entire story where somebody sat on the other side of a table on behalf of the pool. Every other number we have talked about today was produced by people responding rationally to a set of rules. This one was produced by an argument. That matters more than it sounds. A price that gets argued over is a price somebody is allowed to argue with. It is not whether. Although the room is getting emptier, 7 insurers have announced they are leaving the marketplaces, in some states or all of them, for 2027. Cigna is exiting all 11 states where it sells, affecting more than 350,000 people. 5 other carriers announced they are entering new states, which is the part that usually gets left out. But fewer companies in a state means fewer choices and less reason for anyone to sharpen a pencil. So, back to where we started. Your insurer is not allowed to look at your medical history. It genuinely cannot price you on you. Which means that when the new prices go up on November 1st, the number you are looking at is not really an answer to how your year went. It is the answer to a completely different question. Who else is still standing in the pool with you? That is a strange thing to find out. It is also, I think, the single most useful thing to understand about health insurance, because it explains the part that always felt arbitrary. Your premium went up, and nothing about your life changed. Both of those can be true at the same time, and now you know why. Insurance does not price your risk. It prices the pool you're standing in. Educational only, not financial advice.